This is the Asia Trade. I'm Paul Allen in Sydney, where markets have just opened. The top stories this hour. A cautious open ahead for Asia as investors await the US jobs report for fresh clues on the Fed's interest rate path. A global gauge of emerging market stocks entering a correction. Wall Street's big banks said to be planning double-digit bonus bumps for traders and deal makers, and the biggest increases since the pandemic. And we look closer at the shifting political climate as BlackRock becomes the latest money manager to quit an industry group targeting net zero emissions. Okay, we're up and running here in Sydney for the final day of trading of the week. It's a staggered open, of course, so hard to get a read on things in the early going, but we are modestly tilted to the upside at the moment. If we take a look at Nikkei futures, they're unchanged right now. A few things to watch in Japan today. We will get household spending for the month of November a bit later on. Seven and I, of course, were out with third quarter results yesterday. Operating profits slipped 24% on broader retail weakness. Of course, they are considering takeover proposals from Couche-Tard and the Ito family. The company saying that they lack enough information at the moment to proceed with that. Still looking at a very weak yen, now softer than 158 against the greenback. Little change there for the yuan. Now let's take a look at US markets. Of course, the equities cash market was closed. It was a national day of mourning for former President Jimmy Carter. A shortened session also for US Treasuries, although in the trading that we did have, we saw yields slipping a little bit ahead of the December jobs report. That report expected to show about 165,000 new jobs added, with the unemployment rate holding steady at 4.25%. Taking a look at oil as well, continues to rise. For the moment at least, falling inventories seem to be outweighing weak Chinese demand. But after that post-winter demand peak, the longer-term market does still seem tilted towards oversupply. Now, we have heard from a lot of Fed officials, signaling that they're going to likely hold interest rates at current levels for an extended period, only cutting again when lingering inflation risks retreat. Boston Fed President Susan Collins suggests a slower approach in easing policy, while the Philadelphia Fed's Patrick Harker says further action depends on the economic outlook. Now, policymakers cut interest rates for a third consecutive time at their December meeting, of course.
I still see us on a downward policy rate path. Looking at everything before me now, I'm not about to walk off this path or turn around. But the exact speed I continue to go along this path will be fully dependent upon the incoming data. We can stay where we are for a little bit, probably not long, but we'll see.
We must be clear in our communication about how further changes are intended to affect economic conditions. We should also refrain from prejudging the incoming administration's future policies. Instead, we should wait for more clarity and then seek to understand the effects on economic activity, the labor market, and inflation.
Just to get to some breaking news as well, we've just had a rate decision out of Peru as well. The central bank there cutting its key interest rate to 4.75%, 4.75%, down from 5% due to low inflation. Inflation slowing to a little bit under 2% in December, so below the 2% target. So that's really set the scene for easing there. The central bank forecasting the economy to grow at about 3% in 2025. Well, Friday's US jobs report is the next major catalyst for market pricing, with economists anticipating solid hiring in December and steady unemployment. Garfield Reynolds leads our Markets Live Asia coverage. And Garfield, the Fed keeps saying, going to be data dependent, data dependent. Well, here's a big piece of data. What's it going to mean?
Well, the interesting thing is, Paul, that this big piece of data might mean a lot in the very, very short term. But you have to question how much actual impact it'll have on policy decision making, considering what we just heard from Bowman and Harker and what we've been hearing from other speakers, where yes, they are on the path of easing policy, but no, they don't think they need to move for a while. And we don't want to prejudge what the incoming administration will do, but they sound very interested to find out, like many of us are, what will the Trump administration do and what will the impact be? Even one of Trump's signal policies, tariffs. If he does impose major tariffs, does that end up being a prices shock or a growth shock or both? That's something the Fed's going to have to wait to see. That's something a lot of us are going to have to wait and see. So given all of that, even an extraordinarily downside jobs report would not lead the Fed to rush to cut rates in the next meeting, or maybe even in the following meeting. And I think that the initial knee-jerk reaction to that sort of report would be to bring rate cuts forward. But then that would degrade precisely because this uncertainty about Trump's policies, uncertainty about a range, of things in the US economy, even, for example, oil prices ticking back up. That's the sort of thing that helps to feed into expectations that inflation is going to take a while to go away. So with all of that, the Fed's going to be very cautious about tacking towards rate cuts sooner rather than later. And the real risk, which is what has equity and bond investors nervous going into it, is if there is an upside beat, does that push us back well into the second half before we can really think that the Fed's going to cut rates?
Yes, certainly doesn't look like an economy in need of stimulus at the moment, but perhaps we couldn't say the same thing about the UK right now. If we take a look at the action in the pound, the gilt market as well, we've got yields surging. The market really seems to be asking some questions about fiscal policy. What are the answers? Well,
I mean, some of the markets, I think the market's questions are being amplified by some difficult things surrounding the setup for all assets at the moment. If you look at UK yields up by many 70 basis points or something since October, well, Treasury yields are up by 65 or so. So yes, British assets are underperforming. Yields are rising faster, the currency is falling slower than a lot, but it's not the way it was when the trust situation played out, where the UK really stood out as being far and away the worst performer and as leading to poor performance elsewhere, especially once the pension funds blew up. I think there's also, especially with the pound, there's still the influence of we're only in the second week of the year. We're still in that thin trading conditions. So the pound dropping to down as much as 1% overnight, then coming back up to be 0.4% down. I don't think you want to read too much into that. That's the market side. But the difficulty, the thing that is similar to some of the previous incidents, is precisely that market action is upping the pressure noticeably on the political and economic outlook for the UK. It's making it much, much tougher for the UK government to take the sort of action that it probably needs to in order to navigate what is a difficult situation. Inflation is still elevated, the economy is slowing down. Who knows quite what you're going to get out of France and Germany and Europe, and for that matter out of Trump. Even if you assume that Trump is not about to target the UK in the way he has targeted some other places when it comes to tariffs and other matters, his potential impact on Europe then immediately rebounds on the UK. Europe is seen as being one of the more exposed major economic areas to things like tariffs against China, anti-China measures, and tariffs on trade in general. So if Europe gets hit, well, the UK is going to get hit as well, even if they have left the European Union.
Yeah, so many questions regarding the incoming Trump presidency. Garfield Reynolds, who leads our Markets Live Asia coverage there. And US President Donald Trump said to be planning to issue several executive orders in the early hours after his inauguration on January 20. Jody Schneider, Bloomberg's political news director, joins us now from Washington. So, Jody, what are we expecting to be the focus of these executive orders?
Yeah, so, Paul, they're in several areas. One is immigration, the border, which, of course, is something that Donald Trump ran on in the campaign that he was going to fix, as well as regulatory issues, energy, and the federal workforce. In terms of the immigration, which seems to be his big day one promise, he wants to tighten border crossings. He wants to get the U.S. to finish that wall that was started in his first presidency, and he also wants to start a path to be able to have mass deportations, as he calls them. On the federal workforce, what he wants to do is put in effect a hiring freeze, as well as try to get federal workers back into the office. Many of them only work from the office several days a week and work from home the rest of the time. Whether he'll be able to do this and whether this will, stand up in court is quite another issue. And with the federal workforce, a large part of the workforce is unionized, and trying to get them back to work is difficult. That's something that President Biden has tried, and without much success.
Yeah, and President Biden is still President Biden for a few more days. He's taking some actions in those final days that are frustrating Donald Trump. What's he doing, and what is the president-elect pledging to do to reverse these policies once he takes office?
Yeah, so President Biden has been very active in recent weeks, and we expect perhaps even more of this in sort of his final week in office before the new administration takes over. He's been doing things like on federal lands, trying to ban drilling near some federal lands, also doing some other regulations regarding energy and the environment. Now, Donald Trump says as part of his executive order, any of these or his executive orders, because there'll be a number of them, what he wants to do is any of the Biden plans that have not yet been finalized that he will just say won't go into effect. So it's unclear, first of all, whether he can do that, and secondly, of course, whether President Biden, what he's doing, will stand. But they're both sort of, one is they're sort of trying to Trump-proof and Biden-proof one another at this stage, it sounds like.
Oh, well, one of President Trump's, incoming President Trump's signature policy ideas is efficiency, and Elon Musk's spearheading that effort. But Musk's expressing some doubts about the government efficiency effort that he's been tapped to help lead. What's the problem here?
Yeah, so Elon Musk, quite famously, when he was given this task, which they're calling DOGE, this Department of Government Efficiency, he and Vivek Ramaswamy, he came out and said he was going to cut $2 trillion from in spending, in government spending. Now that, on an annual basis, is more than all spending on government agencies. It's a huge amount of money, and it couldn't be done without cutting things like Medicare and Social Security, which are really popular programs with voters. But now Elon Musk is saying, well, he's not so sure it'll be $2 trillion, maybe it'll be $1 trillion. How they're going to get there, they haven't said, but the fact is he's taking a look, I think, at how much this would this endeavor would mean in terms of actual, cuts, and perhaps being a little bit more realistic about it. They are not cabinet officials, he and Vivek Ramaswamy. They will still run their companies, run their financial portfolios, but they have been given this task and will report through to Susie Wiles, the incoming president's chief of staff.
All right, Bloomberg's political news director Jody Schneider there. Well, the Financial Times is reporting that Chinese President Xi Jinping will send a high-level envoy to Donald Trump's inauguration. Trump had extended an unusual invitation to Xi to attend the ceremony on January 20. The FT says the attendance of a top Chinese official is unprecedented and intended to reduce diplomatic tensions as the new administration takes over. Coming up on the Asia Trades, we'll discuss Wall Street's exodus from the Net Zero Banking Alliance with environmental advocates NY. Plus, we'll talk Fed outlook with Regan Capital. This is Bloomberg. President Biden says the U.S. government will cover 100% of the costs of the California wildfires for 180 days, calling the devastation catastrophic.
So today I'm announcing that the federal government will cover 100% of the cost for 180 days. This is going to pay for things like debris and hazard material removal, temporary shelters, first responders' salaries, and all necessary measures to protect life and property.
Well, our Los Angeles Bureau Chief John Gittleson joins us now. John, bring us up to speed with the latest.
Well, new fires are breaking out, and the biggest ones have not been contained. So far, we've got official count of 5 dead, numerous serious injuries, more than 180,000 people ordered to evacuate, with the newest, a bunch of people living in Woodland Hills, which is northwest of LA. A lot of celebrities live in nearby Calabasas. So it keeps spreading, and there's no sign of new rain, which we need to, basically put the fires out. Everything is very dry, and you never know where the next hot spot is going to jump out.
Yeah, and to see the fire getting into the city like this, it's extraordinary, it's unprecedented, it's whatever adjective you care to reach for, really. The insurance bill is going to be quite something, one imagines. What are the implications for public and private insurers here?
Well, a few things. We have a story out that says at least $20 billion by one estimate. But at the same time, Moody's put out a note today that said they think the big insurance companies can manage this because it's early in the year, and they made a lot of money last year on all their investments. So they're not worried about insurers going out of business. For homeowners here, though, rates are probably going to skyrocket, and California is already one of the least affordable places to become a homeowner, and that's only going to get harder if you have to include the cost of, paying for your insurance.
Questions also seem to be getting asked about the city's preparedness for something of this scale. Was the infrastructure up to the task?
The infrastructure was not up to the task, and, LA has, the climate's changed a lot here. This is a long drought that followed a couple of years of very high rain, so the plants grew a lot, and then this year they've just dried out. They're really dry. January is usually one of the wettest months. December is one of the wettest months, but we haven't had any rain since April. So you had this dry, tinder conditions, and then all of a sudden this massive windstorm hit earlier this week, and once a little spark lit, it was blown for miles. You had fires, embers flying 2-3 miles, starting new fires. And, people, all the tanks that they filled up in advance to be able to fight these fires ran out of water, and they couldn't get in to put more new water in the tanks because it was too dangerous for people driving tanker trucks to get up there.
All right, Bloomberg's Los Angeles Bureau Chief John Gittleson there. Thanks so much for joining us. We have more ahead on the Asia Trade. This is Bloomberg. Executives at top Wall Street banks are said to be locking in plans to award traders and deal makers their biggest bonus increases since the pandemic. For more, let's bring in U.S. finance reporter Tom Gillespie. So, Tom, tell us about the sort of rewards that are on offer here.
Yeah, well, what we're looking at across the street is more or less a 10% increase or so for deal makers, for traders. It depends on some banks. Obviously, some banks are looking to reward their top earners even more on desks that have been particularly successful. But generally, what we're looking at across the street here is a quarter in the fourth quarter of last year that banks have seen particularly good results, right? There's a lot of volatility when it comes to the trading desks, a lot of people trading around the US election that would have given banks a boost in revenues here. And generally speaking, we're in a period now of declining rates and rising deal making. So gradually speaking, it's an uptick for those across Wall Street right now. How sustainable is this going to be? Is this setting the tone for years to come? Well, it's yet to be seen. I mean, we've got an incoming Trump administration where people are expecting a declining rate environment, but we're also wary about risks for rising inflation. So you're going to have a lot of anxiety continuing for the rest of the year. So normally when you have a lot of anxiety, you have a lot of people taking different bets, different sides of the deals when it comes to trading. And that normally feeds through to higher bonuses, higher revenues for these banks because their clients are doing more activity, basically. When it comes to deal making, generally speaking, we're looking at a pretty consistent uptick so far this year in deal flow. Some mega deals already being reported, that are on the table, reported by our colleagues just this week, in fact, in the energy sector in the US. So going forwards, we should be looking at higher fees brought in by some of these big banks, which also will lead to higher bonuses for deal makers, investment bankers across the street.
Yeah, so the higher bonus is indicative of more deal making, but does it tell us anything about the amount of competition for talent in this space?
Sure, that's absolutely one element here, particularly in the deal-making space in M&A. You've got rising competition from boutique investment banks, firms like Lazard, like Evercore, like Moelis, which are increasingly poaching top talent from some of the bulge brackets, where some of these bankers don't feel like they are getting the kinds of paychecks that they deserve and the kinds of feed through from the deals that they're actually doing and seeing that in the bottom lines of their paychecks. So certainly bulge brackets are particularly aware of that kind of competition for talent, not just among themselves, but with these non-balance sheet boutique investment advisors.
All right, Bloomberg's Tom Gillespie there on, what looks like it's going to be a pretty healthy bonus season for US banks. Let's take a look at how US futures are tracking. At the moment, of course, there was limited trades in the US today. The cash market for equities was closed for a national day of mourning. We have seen pictures today, of course, of the funeral and memorial services for the late former President Jimmy Carter. It was a shortened session for US Treasuries as well. Although there was some trading. We saw yields slipping ahead of the December jobs report. We are expected to see 165,000 new jobs added there, with the unemployment rate holding steady at 4.25%. So that's going to be an important piece of data for the Fed going forward. But anyway, no trading today, but here's what futures are looking like. A little bit softer heading into the final trading session of the week for US markets. Let's take a look at how emerging markets are doing, however. They entered a correction as traders do weigh the policies of the incoming Trump administration. So this reflective of a lot of uncertainty over those policies, also China's growth prospects. The MSCI Emerging Market Stock Index now down 10% since the 2nd of October. Interesting what's been driving those losses as well. The heavyweights, Samsung Electronics, Taiwan Semiconductor Manufacturing, have been leading the declines. That's really been weighing on the index as a whole. Of course, new measures planned by the Biden administration are set to expand the semiconductor trade restrictions to most of the world. We're more ahead on the Asia trade. This is Bloomberg. Just getting some breaking news out of Japan. It is household spending for the month of November. It's contracted a bit less than expected. It's recovered somewhat. Household spending contracted 1.3% in October. Now it's contracting just 0.4%. The expectation was for a 0.9% contraction. So a recovery of sorts, although household spending is still in somewhat of a dark place. We have a very weak yen in Japan as well, 158.11 at the moment. So we are, of course, on intervention watch, and we're on a BOJ watch as well. Data suggesting that the Bank of Japan might be able to move sooner rather than later, but with that very, very weak yen, we might see some action from the Ministry of Finance sooner rather than later as well. Some of the other corporate stories we're following out of Japan. Uniqlo owner Fast Retailing saw strong growth in revenue and operating profit for the 3 months through to November. Demand across Japan, North America and Europe helped offset a sustained slowdown in China. The results suggest the company is on track to establish strong footholds in new markets. Fast Retailing is also closing underperforming stores in China and revamping bigger outlets to drive sales. Japan's ruling Liberal Democratic Party has issued a resolution calling on Tokyo to take concrete action regarding President Biden's decision to block Nippon Steel from buying US steel. The party says this includes a reversal of the decision and specific explanations of the security concerns behind the US rejection. And shares of Japanese automakers look set to benefit from industry consolidation and domestic corporate reform this year. It comes as their Chinese counterparts brace for a potential fallout abroad from Donald Trump's tariffs threat. Senior Asia stock reporter Hideyuki Sano joins us now with more. So Hideyuki, how much of a feature is M&A going to be for Japanese automakers in 2025?
Good morning, Paul. So at the end of last year, we had a major sort of M&A news about Nissan and Honda. And that is sort of taken as a sign that the long-awaited consolidation in the Japanese car makers might have begun. Now, it may be too early to say what's happening next, but the investment community has long thought that consolidation in Japanese car maker sector is necessary, because at the moment there are 5 or 6 major companies, and that's way too much given the rapidly changing environment in the car making industry worldwide. So this is potentially seen as a very good sign that things are moving in the right direction. And another thing that sort of took many investors by surprise is the news that Toyota Motor is now setting an ambitious target of ROE target of 20%. Now, at the moment, the Toyota's ROE is up just around 10%, so it's slightly above Japanese average, but many people think if actually they're going to target a 20% ROE, that probably suggests they are seriously thinking about business restructuring, because doubling the ROE is almost impossible with some sort of financial engineering, such as share buybacks. So that is also seen as another sign that Japanese car makers are getting serious about business consolidation.
How about some of the downstream industries connected to the auto industry, machine makers, banks? What sort of impact might we see on these sorts of stocks?
Yes, that's a very good point. Japan car makers are a very important part of the Japanese economy. There are a lot of suppliers to Toyota and Honda and so on. So also at the end of last year, we had a breaking news that the Nidec, which makes a lot of motors for car makers and other companies. So Nidec bought a small machine tool maker. This was unprecedented in the sense that the Nidec started unsolicited M&A without talking to this company called Makino. And as we now know that M&A has been becoming very popular in Japan in the past 2 years because of the push from the government and the stock exchange to boost shareholders' returns and boost profit growth. So many investors think that there will be more M&As, not just in car makers, but broadly in Japan, and that would be certainly positive. And machine tool makers are probably one of the most likely target of M&As, because generally speaking, their valuations are not that high. So this is going to have a huge impact on Japanese stock market.
All right, Senior Asia stock reporter Hideyuki Sano there. Other corporate stories that we're tracking. Sources say Chinese toy maker Bloks Group has increased its share offering and the allocation for retail investors after the IPO was almost 6,000 times oversubscribed. The maker of Ultraman and Transformers figurines is set to begin trading on Friday, and we're told it raised $215 million in the IPO, with shares priced at the top end of the range. Defaulted Chinese developer Country Garden has proposed new terms with key banks that would slash its debt and lower borrowing costs. The company says the proposal would help it achieve significant deleveraging with a targeted debt reduction of almost $12 billion. It also proposed a debt maturity extension and asked for a reduction in funding costs. And another defaulted builder, Sunac China, has received a liquidation petition in Hong Kong. The city's judiciary website shows a winding up petition filed by China Cinda Hong Kong Asset Management, with a hearing scheduled for March the 19th. The case signals renewed financial and legal stress for the Chinese developer, which first defaulted on a dollar bond back in 2022. Let's take a look at how we're tracking here in Australia now. I've been going for a little bit more than half an hour, so a better read on where things stand. We're just higher by a few points. It was a down day for the ASX on Thursday. One standout, though, the materials sector performing pretty strongly, better by about 0.8%. If we take a look at Nikkei futures, meanwhile, setting up for a little bit of risk-off tone when we get going at the top of the hour. Still to come, JPMorgan, Bank of America and Citi have all quit the Net Zero Banking Alliance. We're going to unpack the implications with environmental advocates New York next. This is Bloomberg. BlackRock says it's parting ways with one of the world's biggest climate investor groups, the Net Zero Asset Managers Initiative. The company says its membership caused confusion regarding investment practices and triggered legal inquiries from public officials. BlackRock had been targeted by Republican politicians for their efforts on global warming, accused of embracing so-called woke policies. And that follows the departure of Wall Street's biggest banks from a similar grouping known as the Net Zero Banking Alliance. Let's bring in Bloomberg NEF Senior Associate for Sustainable Finance, Mikhail Kishimoto. So, Mikhail, is this a signal that major money managers are no longer committed to climate actions?
Hi. So, no, not necessarily. Under the influence of GFANZ, which is the umbrella group for the Net Zero Banking Alliance, banks are developing climate transition plans, which essentially outline their strategies on how they aim to achieve net zero. And also, GFANZ has been providing guidance with a set of elements that these transition plans should contain. Now, in our research, we have found that all of these banks that are leaving the NZBA in the US are doing quite successful in adopting the GFANZ guidance for transition plans. So, for example, they are publicly stating the types of products and services that they offer to support their clients' transitions towards net zero. Or they have also set their own interim emissions targets or their sustainable financing targets as well. So it is indeed a worrying sign that these banks are leaving the NZBA despite having done all of these groundwork for their transition already. But at the same time, this could mean that despite the absence of a formal commitment to net zero, these banks will be ready to continue to capture opportunities as part of the energy transition.
So what's the reason then for the banks leaving the alliance?
Yes, so banks and the industry are stating, as you mentioned, the mounting political pressure against climate-related initiatives in the US as the main reason for their departure from the NZBA. So, in fact, we are seeing more than 20 states in the US starting to introduce anti-ESG policies, which essentially prevent financial institutions from making investment decisions based on ESG factors. And this is in contrast to only about 7 states introducing pro-ESG policies, which promote sustainability. Now, another reason could be that banks are being placed in a difficult position where they cannot do everything for climate just on their own. So, for example, their clients in the real economy need to act, or projects need to be bankable from a financial institution's business perspective as well.
So how is this going to affect global energy transition goals?
Yes, so the energy transition in the US first will most obviously be impacted by the incoming Trump administration rather than by banks themselves. In our research, we have also seen that close to $52 billion of green loans were signed in the US in 2024, which is a historical annual record for the nation. So this could actually be a sign that banks will continue to provide financing for green opportunities as long as they make a good business case, even though they might not make as big of a noise moving forward.
All right, Bloomberg New Energy Finance Senior Associate for Sustainable Finance, Mikhail Kishimoto there. Let's get some more on this with Vanessa Fajans-Turner, Executive Director at Lobby Group Environmental Advocates at New York. Vanessa, thanks so much for joining us. I just want to pick up on what Mikhail was saying there about JPMorgan, Morgan Stanley, Goldman Sachs, Citigroup's they're no longer members of the Net Zero Banking Alliance. What's your reaction to this? What are the real world implications likely to be?
Well, first of all, good morning, and thank you so much for having me. In the U.S., we have a saying from a famous author, Mark Twain, who read his obituary one morning and said, "The rumors of my demise have been greatly exaggerated." This is not the end of climate finance, and it's not even the end of GFANZ or the NZBA. It is the result, as your previous commentator mentioned, of political pressure here in the U.S. There are going to be implications, as there will be from an incoming Trump administration. But fortunately, as I'm calling in from one of the states, New York State, that is pro-ESG and pro-climate action with one of the most ambitious climate laws on the books in the U.S., if not the world, there is much that states can do to continue endorsing, incentivizing, and supporting the global momentum towards a renewable energy transition, even while a Trump administration tries to dissuade it.
Well, if we take a look at the history of the NZBA, it was formed in 2021, but we have Bloomberg data that shows that since its formation, financing of the fossil fuel industry actually increased. So was there a degree of greenwashing going on here?
Certainly. There has been great increases, and the members of the NZBA certainly like to tout the increases in their green, so-called green finance, much of which was green, some of which was less so. But certainly not only did overall fossil fuel financing increase, but fossil fuel financing for things like coal, which is irreconcilable with any net zero goal on the books for GFANZ, also increased among some of the key U.S. members in particular of the NZBA. So the degree to which GFANZ members, NZBA members were using and abiding by climate goals simply because they were members is overstated. The degree to which they will still keep to their climate goals that they have committed to internally, or green hushing them, even if they are not promoting them in the ways they have been, remains to be seen. Do we hope they will continue to do the right thing? Yes. But it's also important to remember this isn't just about banks, and it's not just about climate change. This is about how financial institutions writ large are managing their risk and protecting the money that we're entrusting to them. Because whether or not they continue to abide by climate goals and mitigate climate risk, it's not going away. And we see that now as extreme record-breaking fires burn in California, and we see banks continually increasing their estimates of the damage these fires will cause day to day. JPMorgan today, just 2 days after leaving the NZBA, revised its estimate yet again for a second time, doubling its estimates of the damage to $50 billion. Just a few hours ago. And that's climate risk, real or not.
Well, we still have 80 banks remaining in this alliance in Europe, and the situation in Europe is somewhat different. The bank regulator there has just tightened requirements around ESG. So to what degree do you sort of see a two-tier system starting to emerge here? And what are the implications for climate financing, risk and profitability for US banks versus European banks?
This undoubtedly weakens U.S. leadership in global finance, and it leaves taxpayers and U.S. pensions and businesses vulnerable to not only unchecked climate risks and economic shocks, but discrimination from markets like the EU that have increasingly high standards and expectations about how businesses are doing their business, whether it is mitigating their risk or whether it is supply chain criteria that U.S. businesses are continually downplaying or ignoring. This is going to mean that not only is there a two-tier system in terms of high ambition and low ambition, but there's certainly going to be increasing global competitive edges to those who are being more out in front of the climate and renewable energy transition.
So you've just released your action agenda for 2025, and in it you say that the time for half measures is over. You're calling for more action. There are a range of policy responses you want to see in the US, but how much cooperation can you anticipate from the new incoming federal government? It might not be too sympathetic to some of your proposals.
I don't think we're counting on much support from the federal government that is coming in right now. The thing that we are noting is that New York itself has a great deal of not only symbolic importance as the epicenter of the global financial sector, with apologies to Hong Kong, but also to certainly with special authorities because of the geographic location, the tax base that many of the largest banks noted here today have here in New York City on Wall Street. And for that reason, New York State is in a very unique position to do some of the things that either federal government will not do and that banks will not voluntarily do. There are things like mandating emissions disclosures and climate risk disclosures, which we have seen become law in California. There are things like lobbying disclosures that will require banks and other financial institutions to be clear about the policies they are fighting or supporting. There are other types of financing conditionalities that we can explore. There are a number of regulatory notions that New York State itself can implement alongside other states like California. New York is itself the 10th largest economy in the world when compared with other nations. And California itself is the 5th. And in that way, these two states alone can account for a great deal of market leadership and sends very strong signals.
All right, Vanessa Fajans-Turner, Executive Director for Environmental Advocates in New York. Thanks so much for joining us. We have more ahead on the Asia Trade. This is Bloomberg. Apollo Global Management says the lines between public and private markets are starting to blur as financing options grow. Co-President Jim Zelter told us exclusively how they're navigating this changing environment.
I think 24 was a pivot year. For us as a leading firm in this industry and in this sector, there was a great headline, and you and I talked about, the three of us have talked about on this show many times, where the great battle between private capital and banks. The reality is, if you look at the commercial dialogue going on between the top 5, top 10 institutions and the handful of us that lead our industry, the amount of integration, dialogue, working together on big deals has never been deeper. Obviously, there was our Citibank transaction, our Citigroup transaction. There was a transaction we did with Standard Chartered, BNP. And so I think we're still at the early days. These partnerships need to have substance. They can't be, excuse the phrase, shotgun marriages. They have to be ones that really have substance, dialogue, trust, and some history of doing a lot of transactions together. We've been fortunate in all the ones we've put together where there has been a lot of either history of personnel or of activity. But I think still it's early days, early innings. Now, there's a lot of headlines just to grab headlines, and there's not a lot of substance behind them. But I think that trend of private capital and bank partnerships is going to extend in 25 and 26. And I do think, if you think about the economic backdrop, I do sense that there is a great opportunity for strategic M&A. That clearly feels like it's going to happen. I'm a little bit more skeptical about the massive IPO window. If you look at the last 10 years, equity issuance has been about 250 billion, 50 billion IPOs, 200 billion secondaries. That's removing all the SPAC numbers. I think you still have a valuation issue with a lot of private equity companies that want to come out and do their IPO. And so I think we have a consensus view or non-consensus view at Apollo that that number is going to be not as large as people think. And so the big mismatch, if you have a big credit market, a big equity market, this area of hybrid in between, which we've been talking a lot about, applying capital to those over-levered companies, that's the opportunity of 25 and 26.
5 to 10 years. Will there be a difference between public and private markets?
We don't believe so. I think there will be some differentiations, and I think the question that gets raised right after that question that you ask is, well, is there going to be a massive compression in yields? And the advantage is going to go to those folks that have the bigger, you're going to make money on the origination. The ability to make the $3, $5, $7, $10 billion commitment to XYZ company, that's where you're going to garner the extra spread. But all the things that we're doing in origination, in capital formation, in trying to bring some liquidity to these markets in terms of secondary activity with transparency and price discovery, I think the barriers and what's private is risky and what's public is safe, I think those barriers will be coming down.
That's Apollo Global Management Co-President Jim Zelter speaking exclusively with our colleague Lisa Abramowicz. Okay, let's take a look at some stocks that we'll be watching when trade opens in Korea and Japan at the top of the hour. Seven and I in focus after the company's CFO said both buyout proposals on the table lack detailed information, and they're still considering all options. The company's operating income for the third quarter also missed average analyst estimates, and we'll keep an eye on Uniqlo owner Fast Retailing reporting strong growth in the last quarter, except in China. Nippon Steel also on the radar. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens and looking like a pretty muted end to the week, right? As we've been just kind of dealing with this level of investor trepidation as we get into those key US jobs numbers. There's clearly quite a bit of sort of repricing conversation going on in terms of Fed expectations. One guest that we're speaking to later on actually sees the prospect of having to hike over the next year because there are just that many uncertainties when it comes to the inflation outlook.
Yeah, and we've heard from a lot of Fed speakers as well, and that theme just keeps on re-emerging. We're in no rush. We're going to be data dependent, and yeah, this is a big piece of the puzzle that we're going to get a little bit later on. But there was no trading in the US, of course. Day of mourning for former President Jimmy Carter.
That's right, and sort of it's interesting seeing the visuals from that funeral where it's quite rare to see leaders and previous leaders and presidents from both sides of the aisle coming together in a rare moment of unity. Take a look at what we're watching as we get into the first few minutes of trading here in, of course, Australia has been online for a bit, but just watching Japan as well as Seoul as they come online. Nikkei 225 off by just about 1/10% there. We're seeing some steeper losses in the first few moments of trade when it comes to the topics. We did have household spending falling for a fourth month, so sort of muddying the picture when it comes to how the BOJ will navigate the next couple of months and the potential for a move in that next couple of meetings as well. It's really kind of underscoring the economic fragility that we're dealing with and potentially adding to more reason for the Bank of Japan to be cautious about additional rate hikes due to this, weakness in consumption and need for further confirmation of momentum when it comes to stronger wages and wage growth and sort of resilience in that labour market. Dollar yen is largely unchanged at that 158 level, and watching JGBs as well, given that we have seen some pretty big moves in line with what we've seen for treasuries. Take a look at Korea at the moment as the Kospi also comes online along with the Kosdaq, given the big moves we've seen this week across tech in particular. This is the picture as we see see still a bit of upside broadly for Korean risk assets. This as we continue to monitor the ongoing political situation. Police requesting President Yoon's security chief to appear at 10 a.m. local time for questioning. We understand they're considering seeking an arrest warrant for Park, the security chief, if he continues to defy the third summons, as according to reporting from local media. So that political saga continuing to play out, and we'll be bringing you the very latest as those developments play out, Paul.
Let's take a look at how we're tracking here in Australia. The broader index kind of flat at the moment after the first hour of trade. One stock that we are watching closely, Star Entertainment Group, the casino operator, it's having another horror session, sliding a little bit more than 13% now. The company, to put it short, is running out of money. The stock's down about 80% since July. The Financial Review reporting that the company is unlikely to find a backer in its current form and is on track to run out of cash. So that's the worst performing stock on the index again today. The Aussie dollar now sitting just below 2 cents. So we've got yield on the 10-year 4.67. Yields are backed off a little bit. It was a shortened session for US Treasuries in the United States due to the day of mourning for Jimmy Carter, but yields have slipped a bit ahead of the December jobs report. We are expecting 165,000 new jobs to be added, the unemployment rate holding steady at 4.25%. Now, Thomas Barkin of the Fed has been among those making remarks. He thinks that the recent rise in long-term rates reflects a higher risk premium, not concerns over inflation, although there's plenty of debate over that. We've had a number of Fed speakers talking today. Let's have a listen.
I still see us on a downward policy rate path. Looking at everything before me now, I'm not about to walk off this path or turn around. But the exact speed I continue to go along this path will be fully dependent upon the incoming data. We can stay where we are for a little bit, probably not long, but we'll see.
We must be clear in our communication about how further changes are intended to affect economic conditions. We should also refrain from prejudging the incoming administration's future policies. Instead, we should wait for more clarity and then seek to understand the effects on economic activity, the labor market, and inflation.
Well, our next guest sees a range of upside inflation risks in 2025 and believes that the Fed may even ending up having to raise rates to fight off higher prices. Joining us now is Skyler Weinand, who's the CIO at Regan Capital. Skyler, really great to have you with us. And this is kind of the big area of uncertainty, right, for markets and investors and economists going into this year. How much of that comes from political risk, do you think? Is this sort of potential price upside that you see from fiscal policies in an incoming Trump administration?
Yeah, I think it's threefold. I think it's political risk. I think it's, the governor talked about term premium and the risk associated with longer duration assets. That's moved tremendously. It's moved 75, 80 basis points since September when the Fed cut interest rates. So that speaks to demand. Is the demand there for duration? Is European, Japanese demand going to be there for U.S. Treasuries? But also, I mean, I laugh when they say that they have no idea what incoming policies and how they'll affect the market in inflation. Because in their last Fed notes, they were actually talking about that. So they have notes where they're worried about incoming inflation, fiscal deficits, et cetera, but then they're saying, oh, we're going to be data dependent. The Fed is worried about the incoming administration, continued money printing, $2 trillion fiscal deficits, but on the other side, you have an extremely strong consumer and corporate balance sheet. GDP expectations, Atlanta GDP expectations just rose to, I think, 2.7. So the consumer is going to continue to spend. There's a tremendous amount of dry powder. All these things bubble up to higher interest rates out 5 to 10 years, 5 to 10 year part of the curve.
And in fact, I wanted to kind of put to you our MLive blog question of the day, right, which takes a look at, do we really see the meaningful, possibility of one cut from the Fed, two? Because the question is, are traders right to price in just one? That's what traders are looking at. The Fed's latest projection shifting to 2 rate cuts in 2025. Do you think it could actually be none, and we could have to see, how that fiscal outlook plays out? And I suppose, do you think that uncertainty comes from the fact that, well, we don't know what President Trump's administration is going to do versus what he's alluded to doing?
I mean, talk about uncertainty. It was only 3.5 months ago where we were pricing in 10 cuts, and now we're talking about 1 or 2. Since September 17th, the day before the Fed cut interest rates, 50 basis points, the bond market has lost over 4%. 5 to 10-year parts of the curve are up 100 basis points. So they want to cut. I think they want to get to 4. They want to put at least one more cut in. I think while that occurs, 5, 10, 30-year rates continue to rise above 5%. But to put this into context, this is great. We want, the economy wants and needs a steep curve. We've been living in bizarro world for the last 2.5 years with an inverted curve. And bizarro world really since the GFC, since 2009, since the Fed cut interest rates to 0 and flooded the economy with cash. So they're going to cut maybe one more time. The back end's going to go up to 5+%. We're going to have 100 basis points of steepness. And if you look at Japan right now, for example, Japan actually has 200 basis points of steepness between 2s and 30s. And so, Japan's talking about raising rates shortly. So this is good, but they might cut once, but we could see in the second half of the year them actually raising rates again because inflation might pop up, spending might get out of control, which are all good things, honestly.
Yeah, Skyler, I'm glad you raised Bizarro World. I want to lean into that a little bit more because we seem to forget that part of the reason the Fed's not cutting is because this economy doesn't need stimulus. It's in pretty good shape. So if you look at markets, earnings, good old-fashioned fundamentals, is that going to be enough to drive prices higher?
What is welcome for the first time really since pre-GFC is good and bad again. We lived for the last 15, 17 years where the market wanted bad news and they wanted the Fed to keep rates at 0 in order to continue to stimulate the economy. Okay. Now we're just back to normal where, GDP's up. That's great. People are going to spend money. Economy's doing well. Corporates are doing well. So it's really a generational thing. Can you move your mind back to 05, 04 when good news was good news? If you can think in that type of an economy or that type of a market, you're going to do well. Okay? But if you're holding on to 0 interest rate policies and quantitative easing and the Fed put, then you're likely not going to do well in this market.
Well, let's talk about some areas where you can do well, and tech, particularly tech linked to AI, has been performing very strongly. How are you looking at this area? Do you think it's overvalued? Do you add when you see dips? What's your plan?
No, AI is generational. It is the equivalent to the internet, power, the Industrial Revolution. So I think the move in the market has really only just started to begin, okay? I don't think it's just an NVIDIA play. NVIDIA is a hardware play. Look to software plays. There's some private companies out there that are getting extremely good valuations and multiples over very short amounts of time. 12, 24 months, these up-and-coming companies are doubling, if not quintupling valuations. But you can also look to the big players. You can look at Meta, Google, and Microsoft really as a triumvirate on the software side. But NVIDIA, I think, still a great play on the hardware side.
Skyler, before we let you go, I just want to quickly get your thoughts on China as well. I know you have a wait-and-see approach there. What are you waiting to see?
Well, You look at Japan, for example, you look at the United States, you look at the UK, where we're looking at 25, 30, 40-year highs in interest rates. China's going the other way, right? So for good reason, growth is being decimated. And the wait and see approach is, what exactly is the government going to do to stimulate the economy? Are they going to flood the economy with cash? Are they going to go through in another building craze, building tons of apartment buildings where nobody lives in? We have no idea, okay? So it's really wait and see relative to looking at Australia, looking at the UK, US, or Japan, where rates are rising, the economy is doing well, and consumers and corporations are flush with cash.
Really great to have you with us, Skyler Weinand, who's the CIO at Regan Capital. Let's take a look at some of the stocks that we're watching across the Tokyo session, and 7&I is one of them. We're seeing downside of about 1% at this point, as we see really the profit disappointing there. Also, of course, some trepidation when it comes to what's going on when it comes to Alimentation Couche-Tard's takeover proposals. We have seen that special committee of 7&I Holdings board and the founding Ito family being formed, but lacking enough information to sort of evaluate these details there. We did see operating profit falling 24% in the latest quarter, broader retail weakness at play there, despite some of those signs of the Japanese as well as North American recovery. That's clearly not the theme that investors are focusing on today. Across the other sort of retail space, fast retailing, of course, a heavyweight. We're seeing a fall of over 6% there. And that is, again, on earnings disappointment, but also the concerns that we could continue to see further downside given the weakness out of China, as well as the demographic shrinking for the local Japanese market as well. But first quarter Uniqlo Japan operating profit was a miss on estimates in the previous session as well. Still ahead on the Asia trade, almost 180,000 people forced from their homes by Los Angeles wildfires as President Biden fast tracks federal aid. We get the latest next. This is Bloomberg.
So today I'm announcing that the federal government will cover 100% of the cost for 180 days. This is going to pay for things like debris and hazard material removal, temporary shelters, first responders' salaries, and all necessary measures to protect life and property.
President Biden there announcing extra federal assistance to California as the state deals with the devastating wildfires. Let's bring in ABC reporter Alex Stoner in Altadena, California. So, Alex, that's a very confronting scene around you there. Can you tell us what's been going on and what's the latest?
Well, Paul, hello to you. Firefighters here are trying everything they can to get an upper hand on these flames, and they have not been able to do that yet. There are firefighters arriving now from all over the West, many hundreds of miles away, who are coming in. We've seen them today from 300-400 miles away. Many more are driving here right now to offer some support. But you talk about the scene behind me. This is a chiropractic office, and it's completely down to the ground. There are a number of fires that are still burning in there, mainly where there are gas lines that broke and that they are still lit and still putting out fire. But it is like this, street after street after street, and then home after home after home, completely gone. They now believe in this fire, 4,000 to 5,000 structures burned. They don't have an accurate number on that yet. In the Pacific Palisades fire, they think around that same number has burned. The numbers are incredible, and the fires are still burning. Tonight we have a little bit of a lull, but later on during the overnight hours tonight, the expectation is that another strong Santa Ana wind event is going to come in and could get this all going again.
So on the one hand, there's a wind. On the other, there's lots of other challenges in terms of how the difficulties have been in trying to contain these fires, right? What's the sort of water shortage situation doing?
Well, here on this fire, Heidi, there hasn't been one, but there have been reports on the Pacific Palisades fire that there were issues with water pressure in the fire hydrants. And there are a number of different reasons why that may have come into play. There were some early indications, or at least people making claims, that it was a lack of water in a reservoir. It doesn't seem that it was that, but more that there were other logistical reasons why the water pressure in the hydrants was low. They're going to have to deal with that and figure that out. There is enough water to fight these fires, at least this one. We've seen firefighters constantly filling up at the fire hydrants around here. This has really been a manpower situation of not enough firefighters. We have this many fires, and there's a new one that just broke out in the last half an hour in the West Hills area of LA, and that one is causing evacuations right now. But luckily, the wind is calm enough right now, they can get heavy air attack in and begin hitting it from the sky with what they call the VLATs, the very large air tankers, and the helicopters, and really try to knock that down. Last night, there was a new start in the Hollywood Hills that went off, that started. And in that one, it was some scary times near the Hollywood sign, near the iconic Griffith Observatory. They quickly were able to jump on that one and knock it down. So it's this kind of whack-a-mole going on right now, where they are jumping on a lot of these fires. But this one and the one in Pacific Palisades, definitely the largest. And they still don't know on this one how many people were killed. They know at least 5. They're going to have to bring in cadaver dogs to go into these buildings and look through what's left and try to find human remains.
Yeah, Alex, at least 5 people killed, as you say, but also you mentioned the thousands of structures destroyed. People have lost their homes. People have been evacuated. Where are those people now? What's being done for them?
Most have just gone out of the area. They're in hotels. They've gone to be with loved ones. They've just had to go, and they've had to go anywhere that they can. And we know in all of these fires, with the evacuations, hotels are full around LA right now because people have been told they just have to evacuate. Now, there are always some who don't go. We have seen people roaming around this area who refuse to go. And they're putting their lives in danger, and the firefighters don't like that, but they're not going to carry anybody out. They can order an evacuation, but under California law, they cannot force you out of your home. If you leave, they won't allow you back in, but they can't make you leave. So a lot of people decide not to go, unfortunately, because we do deal with wildfires a lot here in California. People feel like they're somewhat comfortable with them, but in mass, most people left, and many are in hotels.
ABC News reporter Alex Stone there in Altadena, California. We really appreciate your time with us today. More ahead on the Asia trade. This is Bloomberg. We do have an alert just crossing the Bloomberg where the U.S. Supreme Court has allowed President-elect Trump's sentencing in the New York hush money case. The Supreme Court clearing the way for Trump's sentencing in this criminal case, which kind of deals him a symbolic setback as he prepares, of course, to begin his second term in office. Over 4 dissents, the justices rejecting Trump's request to halt the sentencing as state appellate courts have considered his claims of presidential immunity. That sentencing is now set for 9:30 a.m. on Friday. A New York judge has already said that Trump won't be sentenced to prison, but that sentencing will go ahead. It will come as a blow to President-elect Trump, who has argued previously in legal filings that allowing that sentencing to go forward would be a distraction to his transition and undermine his standing as a world leader during his second term. Well, Apollo Global Management says the lines between public and private markets are starting to blur as financing options grow. Co-president Jim Zelter told us exclusively how they're navigating this changing environment.
I think 24 was a pivot year. For us as a leading firm in this industry and in this sector, there was a great headline, and you and I talked about, the three of us have talked about on this show many times, where the great battle between private capital and banks. The reality is, if you look at the commercial dialogue going on between the top 5, top 10 institutions and the handful of us that lead our industry, the amount of integration, dialogue, working together on big deals has never been deeper. Obviously, there was our Citibank transaction, our Citigroup transaction. There was a transaction we did with Standard Chartered, BNP. And so I think we're still at the early days. These partnerships need to have substance. They can't be, excuse the phrase, shotgun marriages. They have to be ones that really have substance, dialogue, trust, and some history of doing a lot of transactions together. We've been fortunate in all the ones we've put together where there has been a lot of either history of personnel or of activity. But I think still it's early days, early innings. Now, there's a lot of headlines just to grab headlines, and there's not a lot of substance behind them. But I think that trend of private capital and bank partnerships is going to extend in 25 and 26. And I do think, if you think about the economic backdrop, I do sense that there is a great opportunity for strategic M&A. That clearly feels like it's going to happen. I'm a little bit more skeptical about the massive IPO window. If you look at the last 10 years, equity issuance has been about $250 billion, 50 billion IPOs, 200 billion secondaries. That's removing all the SPAC numbers. I think you still have a valuation issue with a lot of private equity companies that want to come out and do their IPO. And so I think we have a consensus view or non-consensus view at Apollo that that number is going to be not as large as people think. And so the big mismatch, if you have a big credit market, a big equity market, this area of hybrid in between, which we've been talking a lot about, applying capital to those over-levered companies, that's the opportunity of 25 and 26.
5 to 10 years, will there be a difference between public and private markets?
We don't believe so. I think there will be some differentiations, and I think the question that gets raised right after that question that you ask is, well, is there going to be a massive compression in yields? And the advantage is going to go to those folks that have the bigger, you're going to make money on the origination. The ability to make the $3, $5, $7, $10 billion commitment to XYZ company, that's where you're going to garner the extra spread. But all the things that we're doing in origination, in capital formation, in trying to bring some liquidity to these markets in terms of secondary activity with transparency and price discovery, I think the barriers and what's private is risky and what's public is safe, I think those barriers will be coming down.
Apollo Global Management Co-President Jim Zelter speaking exclusively there with our colleague Lisa Abramowitz. Let's just check in on Star Entertainment here in Australia, continuing to slide another 13.5%. It's now off more than 40% over the past 2 days. The company running out of cash. The Australian Financial Review reporting that it's also unlikely to find a backer in its current form. This is Bloomberg. Just getting a little bit of data out of Australia. It's household spending for the month of November. It's continuing to slide, 2.4% expansion. We were looking for a 2.5% growth there. Follows on from some pretty disappointing retail sales numbers that we had earlier this week as well. The consumer, suffice to say, in a pretty dark space in Australia at the moment. Got the Aussie dollar also slipping a little. It's now below 62 cents US. On equities markets, meanwhile, it's also a risk-off day. We're kind of, we're down about 0.5% in Japan, off about 0.25% here in Australia. The Kospi faring the better out of the major markets that are open. Stocks in Korea looking pretty flat at the moment. Heidi.
Yeah, take a look at how European futures are opening at the moment. Stoxx 50 futures looking like this. This is the picture, pretty muted there, about 0.4%. As we sort of just see quite a lot of that sluggishness as we continue to wait for those US jobs numbers. But certainly when it comes to retail stocks in the UK, we'll continue to watch the weakness in their really tough consumer and broader economic backdrop there. We've also seen a little bit more of an upside when it comes to broader Euro stocks as sort of policy in the US is in focus. But of course, that risk of tariff concerns remaining a key theme. Fourth quarter earnings season also starting to loom as well. And let's bring back Garfield Reynolds, who leads our Markets Live Asia coverage. So, obviously front and centre will be those jobs numbers. We were kind of talking about the pricing around 1 or 2 cuts from the Fed. We had a guest earlier saying that, they may need to hike in the second half.
Yes, I think in a lot of ways that's the concern that's hiding behind shifting back and forwards between are there going to be 2 cuts? Is it just going to be 1? All of the Fed speakers so far have been pretty clear that They're still in easing mode. There's been several of them that have explicitly acknowledged the so-called dot plots, the median forecast from Fed policymakers for 2 rate cuts this year. So that's their base case. The concern that is growing in some parts of the market is that the Fed will either end up cutting but then hiking, or end up hiking and not cutting at all if inflation was to revive. And even if you didn't have a change of administration, the existing policies and the existing economic setup in the US was already raising the potential. There were some warnings from some members about the potential for inflation to come back up. That's part of why they had the fairly hawkish language when they cut rates in December. It's also part of the reason why they're feeling particularly cautious about waiting to see what happens when Trump takes office. So that's definitely a concern that is, I think, lurking in the background, that the US economy is doing very, very well. Paul was saying earlier, it doesn't look like an economy that really needs a rate cut right now. That brings with it the potential that it's an economy that's going to end up needing a rate hike before it needs a rate cut.
Let's take a look at the other side of the Pacific, meanwhile. The case slowly building for the BOJ to move sooner rather than later. What are the implications for the yen, which looks like it could really need some support right now? And are we going to see intervention?
Yeah, well, the very fact that there's potential for yen intervention, that actually feeds the narrative that the BOJ might take its time. If you're for a lot of central banks, like take for example, if in Australia the Australian dollar was to move significantly lower from where it is now, not just against the US dollar, but against a range of currencies, and that was going to raise concerns for the RBA that you would get a revival of inflation. The RBA would almost certainly move to put that concern on the table. It wouldn't intervene in order to set a floor for the Aussie dollar in that way, but it would point out that, look, lower currency means too high inflation, and we're not okay with that. The BOJ, even with that wages data that we had yesterday, even with other signs that here's an economy that needs a rate hike, it's so glacial in moving towards that. And part of what feeds into that is that intervention potential, that if the yen goes too far, goes too low, there's always the possibility that the government will say, okay, go in and buy yen in order to prop it up. So intervention, you can understand why FX traders are so nervous about it. You've also just got the simple fact that the BOJ has a long history of being very aggressive to support the economy, very willing to do extraordinary monetary easing. It's got very little in the way, in recent or even not so recent history, of showing that it is willing to act aggressively to raise interest rates in order to prevent inflation getting out of control, in order to prevent the currency from getting out of control. So that's a big part of why a cautious approach from the BOJ runs the risk of really setting off yen declines, especially when, as we covered, the other part of the equation is a relatively hawkish Fed. That piles the pressure on the BOJ to also be hawkish, and the BOJ is showing that aggressive tightening is something that's just not in their DNA.
Garfield Reynolds, who leads our Markets Live Asia coverage. Staying with FX, and a sharp divergence in bond yields between the US and China is putting Hong Kong in an uncomfortable position. Joining us now to discuss is Bloomberg Opinion columnist Shuli Ren. And Shuli, much has been said over the years about the dollar peg for the Hong Kong dollar, and you're arguing this now 41-year-old peg makes less sense than ever.
Yes, so Hong Kong Monetary Authority put out a statement yesterday saying that it has no intention or plan to remove the peg, but that's not going to quell market dissent that the Hong Kong dollar, the dollar peg has run its course, and it's time for a revamp. I mean, take a look at the Hong Kong's rise in the last 20 years. Of course, it was China's economic rise, but very importantly, Hong Kong was the Asia's go-to fundraising center, right? Like companies come to Hong Kong because we just have a cheaper cost of borrowing. But look at what's happening now. Because Hong Kong dollar is pegged to the US dollar, the cost of funding in Hong Kong is higher than that in mainland China. I mean, just look at New World Development. It's Hong Kong's flagship real estate developer, right? It has been trying to raise more yuan loans in order to lower its total cost of borrowing. For instance, in August, they said that they raised the yuan loans at only 3.1%, but their Hong Kong dollar loans is about 5.1%, depending on HIBOR. It's just too high. Also, look at the mortgage rate. Amazingly, like Hong Kong's mortgage rate is higher than that of Shenzhen. This is just unheard of, unprecedented, and our property market can never recover if the cost of borrowing is this high.
Well, it sounds like it's not a good time to remove the peg, but it's probably never a good time for Hong Kong to remove the peg. So how does the government do it, should it want to?
Well, first of all, I think Hong Kong, we should do it on our terms, right? Like over the years, there have been a hedge fund short sellers trying to attack Hong Kong's dollar peg. If we cave to their short selling campaigns, that would be a very bad idea because that will only encourage more speculative trades. But secondly, I think it's important to boost the Chinese yuan's liquidity in Hong Kong. I mean, if you look at the, for instance, Hong Kong dollar loans, investors have been trying to use, say, like yen-funded loans to make investments because the yuan offshore the liquidity is just not very good. So Hong Kong government needs to figure out how to boost the yuan liquidity. I mean, take a look at Macau, right? It also has its own currency, but Macau's currency doesn't really matter all that much because in Macau, you can use the Hong Kong dollar freely and the yuan freely. And whereas in Hong Kong, I mean, we still largely rely on our own currency. And I think that needs to be phased out over time.
Bloomberg opinion columnist Shirley Ran there, and we do have one development that we're following when it comes to BlackRock. They're said to be in talks to sell Authentic Brands stake in that group. So an investor group said to be in talks to buy BlackRock's equity stake in Authentic Brands Group. But we're hearing that the deal could value the stake at $3 billion or more. Remember, back in 2019, BlackRock paid $875 million. It includes within that group the existing investors as well in Authentic Brands, CVC Capital Partners, General Atlantic, Leonard Green, as well as HPS Investment Partners, and perhaps some other names there as well. So watching that quite closely.
All right, we've got more ahead on the Asia trade. Stay with us. This is Bloomberg.
Watching how we're trading in Hyundai Motors early in the session, just about 40 minutes into the start of trading. A little bit of upside there. We are seeing that rise, although off the session highs of as much as almost 5% in Seoul. Hyundai Motor announcing a strategic partnership with NVIDIA to accelerate the development of advanced AI technology, so helping manage data required to develop and train its AI models for various applications. So a bit of upside there.
Let's take a look at how Apple's suppliers are tracking in the Asia-Pacific at the moment. Something of a mixed bag. SK Hynix continuing to have a very good day. Samsung Electronics continuing to move in the other direction. It's Samsung Electronics slide, which is actually weighing on a broader index of emerging market equities as well. Sharp, meanwhile, having a better experience in Japan, better by about 0.5%. But some of the difficulties for Apple relate to what's been going on in Indonesia. The Vice President of Global Affairs has left Indonesia with a ban on the iPhone 16 still in place. Now, this is despite President Prabowo Subianto approving the tech giant's billion-dollar investment plan just last month. Bloomberg sources say the Indonesian industry minister scuttled that deal in a late-stage about-face, and Apple's been told its plan that included a factory to produce AirTags still falls short of local manufacturing requirements. Well, Bloomberg opinion columnist Catherine Thorbeck has been writing that the showdown between Apple and the Indonesian government has turned into a spectacle, and joins us now to discuss this. Catherine, how did we get here?
Good morning. So I think Indonesia is really not backing down from its hardball approach to taking on Apple. And right now it might be seeing this as a win. You know, it seems to have gotten Apple to cough up more and more money. First, reportedly $10 million investment offer, and then a $100 million investment offer, and most recently a $1 billion investment offer. But it's still upholding this iPhone 16 ban. So Indonesia might be sort of celebrating this, but I think what it's really sort of exposing to the world is just how difficult and what a costly headache it is for foreign companies that want to do business in this market.
What are the next steps here, given what could be construed as sort of mixed messaging, right?
So I think it's really interesting because right now Apple only has a 1% market share of the smartphone market in Indonesia. But that said, Indonesia does represent a significant potential growth engine for Apple. You know, it has a very young and tech-savvy population. It's the world's 4th most populous country, and there's more active cell phones there than people. So I think Apple is sort of strategically trying to play the long game as long as it can and stick this out if it wants to unlock this, potential growth market. But at the same time, I think Indonesia really needs to sort of find a way to reach a truce here. You know, there's very, very high competition for foreign investment among other countries in the region. And Malaysia and Vietnam have really sort of focused on making themselves very attractive destinations for tech companies. And I think Indonesia might sort of, I don't think its wins here are sustainable. I think it might need to sort of follow that playbook now.
What's quite interesting is you talk about just a limited market share, right? Is it sort of too late without that first, come first serve advantage for Apple? How much can they claw back even when they do get access, right? We know that this is such a big, tech savvy young demographic, but the Chinese tech names have already got quite a foothold.
So I think Apple's really playing the long game. You know, right now, a vast majority, I think 80% of Indonesian consumers go for devices that are priced under $200, which is, right now a far cry from Apple's sort of more premium offerings. But I think Apple does, want to get its foot in the door and sort of establish its name there as this, market matures and as more, consumers do sort of drift to the more high-end products. But right now, as you mentioned, 4 out of the top 5 smartphone makers in the country are Chinese brands. And amid all of this sort of saga between Apple and Indonesia, Honor, the Huawei spinoff, has actually announced that it's going to enter the market. So, competition is really becoming fierce in Indonesia right now for smartphones.
Bloomberg Opinion columnist Catherine Thornberg there from Tokyo. Well, speaking of China and sort of when it comes to the influence from China in the emerging market stock index and sort of broader EM assets, we're still seeing that pretty strong drag despite perhaps, a perceived decorrelation within that EM basket over the last few years. That drag is really part of what we've seen to cause this, in addition to what we've seen across US assets and the strength in the dollar, right? Emerging market stocks now entering a correction. We are seeing the MSCI EM stock index dropping 10% now since October 2nd. A lot of those heavyweight losses include the likes of Samsung Electronics, Taiwan Semi as well. But really, this has been a free fall since October with that caution ahead of Trump's inauguration, the uncertainty about, tariff plans and how that plays out for major economies like China, but also across the rest of the EM complex. Have we, though, Paul, seen sort of, I guess, some outliers to this broader theme?
Yeah, one of the outliers has been in Korea, and you mentioned the decline that we've seen in Samsung that's weighed on this. I mean, at the same time, SK Hynix, one of Samsung's competitors, has been performing quite well. And the Kospi more broadly has been somewhat immune to the political turmoil that we've seen in South Korea. That is continuing to play out. Although that said, we are seeing a risk-off day in Korea today. The Kospi's off about 0.4% right now.
Yeah, continuing to watch that ongoing saga with a third summons for President Yu's security chief now. Well, coming up next, popular Chinese maker of Ultraman and Transformers figurines, Bloks, is poised to begin trading in Hong Kong. More details coming up. This is Bloomberg.
Bitcoin has soared more than 30% since Donald Trump's election win as investors hope for looser regulation under his administration. Bloomberg Originals has been looking into crypto's wild ride and how the president-elect went from a skeptic to a believer. Here's a preview.
They call it the honey badger of money.
The honey badger doesn't care. It really doesn't give a
It's going to do whatever it wants to do.
And right now, Bitcoin wants to go up.
And a record run Bitcoin tops $100,000.
I think Bitcoin was on the ticket this year for this election.
Donald Trump's return to the White House has coincided with record highs.
This is the first time a soon-to-be sitting president of the United States is coming in on a campaign explicitly supporting Bitcoin, digital assets, crypto more broadly.
I will fire Gary Gensler.
He has personally benefited from investments in crypto.
So what happens when everyone from your grandmother to potentially the SEC buys into crypto? And even the President of the United States has skin in the game.
There's obviously big risks with the president tied to the mast of this really volatile industry.
Subscribers can see that report in full right now on the terminal and on Bloomberg.com. It will also be up on the Bloomberg Originals YouTube channel a little bit later on. We'll take a look at some of the stocks that we're watching in Japan, and a lot of these are on really diminishing profit expectations as well as pretty weak sales. This is the picture when it comes to Seven & I. At the moment, we are seeing downside of about 0.6%. Third quarter really kind of lacking updates when it comes to what investors are expecting when it comes to the proposed management buyout. The company didn't provide any more information. Third quarter earnings also saw no big surprises either, as largely in line with brokerage estimates there, but it was really the focus when it comes to the acquisition offers and the bidding on York Holdings, and investors didn't get any of that. Seven & I's CFO also says that the buyout proposal still lack sufficient detail, so we continue to watch the reaction to that. A little bit of downside there. Steeper downside though for Fast Retailing, the unicorn owner falling the most in 5 months on these ongoing concerns over the Chinese market. This is the largest overseas market for Fast Retail. Strong demand though in other markets, but sales and profit in China declined. The company closed underperforming stores and revamping some of the others, but still kept that full year forecast unchanged. Still downside of almost 7% at this point. And also just watching Nippon Steel as well, one of the other sort of moderate laggards there, as we continue to sort of watch for the reaction to really the impasse that we see there. We'll also say Chinese toymaker Bloks has increased its share offering and the allocation for retail investors after its Hong Kong IPO was almost 6,000 times subscribed. The maker of Ultraman and Transformers figurines is set to begin trading on Friday. Catherine Nine leads our Asia stocks coverage and joins us now. And Catherine, there's a real hype over a number of these kind of toy makers at the moment. What are we seeing here?
This is, there's quite a number of things to look for here this morning. It's going to start trading in about half an hour blocks. Right off the bat, when the retail portion opened up, people were excited. This had been, as you just mentioned, thousands of times oversubscribed by the retail portion. It was marketed and it was priced at the top end of its range. There was just a lot of excitement, both just for the Hong Kong IPO market in general, but also for the toy space. We saw this with Pop Mart last year that really took off. That stock was one of the top performers in China last year. And here we are, Ultraman and Transformers makers. I mean, this is just a really interesting space to be in, despite sort of the broader macro picture of, the downturn and people really sort of counting their pennies and worrying about, spending. This is an area where is really thriving, the sort of like lower tier market that's really thriving and is doing quite well.
And the interest from retail investors has been extremely strong as well. Can you get an interest-free loan to buy the stock as well? What's happening?
Yes, exactly. So that was one of the boosts, the zero margin loans that really helped retail investors here get on board. I think that, we've seen a number of stocks in recent months where the retail portion was quite high. I mean, this is just this was a trend that had been in Hong Kong. You saw a lot of retail fervor for some of these kind of IPOs before the last few years when the market really just took a dive and that became sort of non-existent. So, I mean, this is a good sign in terms of just the frenzy and the fervor around the Hong Kong market in general. And to be sure, though, I mean, we saw an IPO yesterday on Unicon Materials that opened, in Hong Kong down 45%. So it's not a sure win, a sure bet by any means or any stretch of the imagination. But this is a particularly interesting one, particularly yesterday we saw in the gray market, it was over, I think it traded up as much as 80%. So we'll see how it goes in about half an hour.
All right, Bloomberg Asia Stocks team leader Catherine Nye there. Let's check some of the stocks to watch when markets open in Hong Kong and mainland China. Keep an eye on Chinese property developers after Country Garden proposed new terms with banks to slash debt and lower borrowing costs. And another defaulted builder, Sunac, receiving a liquidation petition in Hong Kong, while China Vanke's bond distress is also deepening, with almost $5 billion in debt maturing or facing redemption options this year. Tencent's also in focus after it bought back another 4 million shares on Thursday, following its addition to a US Defense Department blacklist.
Take a look at how we're shaping up, Paul, when it comes to US futures, and the sort of muted caution continues to prevail, right, ahead of key US jobs numbers. That data very much in focus there. S&P futures looking pretty lackluster. Taiwan futures also off by about 0.1%. A50 China futures there as well, as there's some consternation as to the PBOC's balance between supporting the currency and further stimulus.